Welcome everybody to today's presentation. Today I'm going to talk about setting up a financial model for a startup. We will explore why having a financial model in place is crucial for the success and growth of your business. Financial modeling provides a comprehensive view of your startup's finances and helps you to make informed decisions. The importance of a financial model is often underestimated, and if you don't have it, you often run in a number of problems. To name a few: inaccurate financial projections, lack of financial visibility, difficulty in fundraising or credit applications, inefficient resource allocation, inability to anticipate cash flow issues, and limited opportunity for strategic planning because you don't have the numbers, you don't have the insight. So for all those reasons, it is important to have your financial model up and running. And if you have it up and running, to continue editing and maintaining it. Is it difficult? No. If you have the time, financial modeling is not that difficult. But if you don't have the time, note that there are people out there that can help you to set it up. Fractional CFOs are perfect. They have the independent view, they have the knowledge, and they can help you to make it work. And I can help you with that too. So let's dive into defining a financial model. What is it? A financial model projects future revenue and expenses, determines the funding needs to achieve your goals, and is crucial for startups to have a solid foundation in place for your financials. So your starting point is always the business plan, and it's basically a translation of your business plan into the future, knowing with all the expenses that you have, the revenue that you have had in the past, and that are a prediction for going forward. You can all put that into the model. Assumptions are a big part of it. It's important to note that assumptions should be positive, of course, but not too positive. They should be realistic to put it into perspective. If it's not realistic, your model is not worth anything. So benchmarking is a good exercise to see, okay, we are predicting this. Is it in line with the market? And that will help you to see, okay, how useful is this model? Key components of a financial model are revenue streams and cost structures, sales forecasts and assumptions, cash flow and financial statements. So if you are a QuickBook or a Xero user, you will recognize those streams. You have a profit and loss, where your revenue streams and cost structures are noted. You have sales forecast and assumptions. That is an addition to what you already have from Xero or QuickBooks. And then you have the cash flow and financial statements. So your balance sheet stating all your assets and your liabilities, and then resulting into a cash flow overview, which is the link between the financial statements and your profit and loss account. It will show how the money flows and when it flows, as the cash flow statement is most of the time, if not always, an overview of a period in time. So your financial model, if you're building one, it should be closely related, because if you update it over time, the resources are mainly coming from your financials. If you make predictions going forward, I make another video on that topic. But talking about the structure of your financial model, it should align with what you already have from Xero or QuickBooks or any other tool that you have. Like I already mentioned in the beginning, the importance of a financial model is that it can help you to plan and achieve and budget and forecast your financial performance. So the key elements include revenue projections, expense forecast, and cash flow management. Those are the areas that need a separate sheet if you do it in Excel, where you can go through all the details and make projections as accurate as possible, and take into account also the timing, seasonality, and those kind of items. So when you are going to build a financial model, like I said, the starting point is always your financials that you already have. Historical data is essential in predicting your future financial data. And then under the assumptions that will change that data and the actions you're going to take from social media, presentations, or sales events, and that will change the data that you have, that will drive the value of your financials forward. So, from that perspective, the starting point, things together in the beginning is your business plan. You have to have your financials, so your balance sheet, your profit and loss, and your cash flow overview, and that's the starting point of getting your financial model started. Assumptions are based on your business plan. If you put your assumptions there, based on what are you going to grow? What kind of activities do you have that are growing things? It's all items that you have to put into your financial model. And simple is better. I would say simple is better. You can make it as complicated as possible. You will see that. But having a simple model that you understand and that you know where the value drivers are coming from is crucial into making it work. Don't overcomplicate things. Sources of data for financial modeling. That's what I just discussed. In addition, I wanted to say industry benchmarks. There's a lot of data out there, and that will help you to see how good is my financial model. Do I need to adjust it? Do I need to tweak it? Why are we above market benchmark? Why are we below it? Do your research, is what I would say. Look at your customers, reach out to them, talk to them, and understand your financial model. That makes the quality of a financial model if you know why things are different from the industry benchmark or different from what your customer normally would do. So it's not only gathering the data from your financials, it's also going out there, looking at benchmark information, looking at customer behavior, and making the data as hard as possible. Meaning that you should do your investigations to when you're setting this up and have an explanation why it's different from the data that you found. Common mistakes to make that you can avoid making when you're going to create a financial model. Um, Buying software is the first one. You can buy software, but if you don't know your goals, if you don't want to spend all the time in mastering that software, I would really advise putting it into Excel. It's flexible, you can change it. It's probably already part of your business software package. I would really recommend using that. It's easy to do, it's easy to understand. You can make links to underlying data. It's really worth doing it. Starting there, not buying software, because that's a commitment too. It will drive your costs up. And before you know it, you're locked into a software solution that you don't like when you start really working with financial modeling. Other things that you have to take into account is overcomplicating the model, unrealistic assumptions, being way too positive to make the numbers nice. You're only fooling yourself, so don't do that. Ignoring seasonality and cycles that you have. Um, yeah, make it as accurate as possible. If you're selling tulips, for example, you're not going to sell a lot of that in December, so adjust your model. Um, Not reconciling balance sheets is also a good one. So if something happens, if your balance sheet is all of a sudden taking a hit and it's not put into the model, you have an issue because then your model is not accurate anymore. So reconciling the balance sheets which or the profit and loss with your model is crucial to keep it accurate. You should do that on a regular basis. The other thing is lack of documentation because everything is in the head. Of course, you're working with it on a daily basis, but documentation is also key when you look back and want to learn from things. If you don't make notes why numbers are the numbers, at that moment in time, you don't learn from it. It is all guessing and you still don't know anything. So documentation is key in keeping yourself informed about what's happening and learning from the past, because that is what it is about as well. Other mistakes you can make is neglecting external factors. Um, if there is a big crash, market crash, and people are not going to buy, and you don't take that into your model, you don't have anything at the end of the day. You're just fooling yourself because you can't take measures because you don't know the real data. So updating the model is really crucial in doing this on a regular basis. If you all take those points into consideration, you have a good start for knowing what's happening on a daily basis or bi-weekly or whatever you decide to do on what's going on with your business, where you are with the business plan, and how to convince other people to invest in you or to get that credit application going. So this is really a good tool to know your numbers and get to that next stage of knowing your numbers. If you have any questions, please contact me. Thank you for watching. This has been 10 minutes, 12 minutes almost. Thank you for watching. If you made it to this point, I really appreciate that. Let me know in the comments what you think about this. And if there's a way I can help you, just let me know. Contact data are on this slide. I thank you for watching this video, and I'm looking forward to see you in the next video.